Hello, had a couple of requests to do videos on picking your strikes on doing options trading. So I'm gonna go. I'll show you kind of how I decide strikes. Everybody's gonna be a little bit different, but so I'm just gonna use the SPY to look at. It actually had a 2 days where it kind of bounced and held the 50-day moving average. So I'm not saying this is going to continue to bounce, but we're just going to use it for an example. If you think this is going to pop back up at some point. So you think, oh, this might get back to the previous high. Okay, so maybe, or maybe somewhere in here, maybe we'll make like 292 our goal, somewhere in that range. And that's possible. So how long is it going to take to get to 292? Now, the way I kind of look at it is when you go to trade, if you're on think or swim, this gives you your implied move. This is based on the options pricing. That doesn't mean that it's going to do that, but it kind of gives you at least a start. So if we're thinking 292, or well, let's say 292, 292.50, let's just say in that area. And so 292.50 is $4.68 move. So you come over here to your implied move, 488. So that's October 12th then. So what that's saying is that's actually possible by this upcoming Friday then. So let's do a couple other things here too. So what strike to pick now, right? Remembering time decay is going to be working against you here. And let me put Theta in here real quick. And I don't think we need open interest for this. And there we go. Okay. All right, so theta is our time decay. That's how much it's going to lose every single day that it basically doesn't move, doesn't do anything. Now, I need to do there where we can show. Oh, come on. All right, so 292.50 is down here, okay? That's your target price. That doesn't mean that you want to buy that price, because if it takes all week to get to that, and it gets to like 292.49, this is still going to be worth zero. Okay. So you really kind of need to buy a strike. Well, you need to do it one, two ways. Either you need to buy a strike that's going to be in the money, but remember, you're still bleeding off time decay on these though, either way, or you need to go the next week expiration. So let me see if I can explain this. So a 288.50 right now, okay, is just that's the next strike, or well, 288 would be out of the money technically, or well, I think based on their after hours it wasn't. So let's look at 288.50. Let me see if I can see if we've got the same strikes. Yeah, it looks good. Okay. So 288.50. If SPY stays right where it's at all week, this is still going to be worth $0, right? Because if it goes up, you might sell early. That's fine. But let's just say you're holding it until expiration. This is still going to be worth zero. Now, what does that cost you to hang on to for that week? Right here, because this is going to be zero if it doesn't cross that. So you're paying $194 for the first week. Okay, hopefully that makes sense. Now go to next week expiration. Okay, same thing, 288.50. You're paying 271. So you're paying 194 for the first week. You're paying $77 for the second week. Okay, remembering that within 1 week's time, you lose $194 if it doesn't get above that. Okay, so go to the next week out. Let's say it's exactly right that. This is how you can use the Theo price. So we'll say by the end of this week, it still hasn't moved. You've lost $194 there. Our theoretical price here on this one would be, we started at 271, it's down to 195. So you've lost $76. So if you want to look at it this way, that second week, you get it at a discount. If you're buying this week expiration, you really shouldn't hold those for very long. It's got to make a significant move. If it doesn't, you're getting burned in the theta. Okay, so let's do this. So that's you're losing $17 a day, it says. That might be including this weekend still. This one says you're losing $11 a day. That's one thing to take into consideration for picking your strikes, because that last week is the highest rate of time decay. So your options are going to, decrease in value a lot faster than if you go, an extra week out, or, if you start going a lot further out. What's the following week would be what, the 26th is the next one. So let's go 3 weeks out then. Okay, so we're still basing this on this week. Like, we want to do a trade that we want to close out by this week, because remember, our implied move says, yeah, it could get to 292.50 by the end of this week. So look, we can buy different things. We don't have to buy this week's expiration though. So 288.50 here. Now let's see, you're paying 326. And they're saying the price value, if it stays flat, would be 272. Okay, so now I think this previous week we lost $76 sitting on that one. This one you're only going to lose $54. See how this is starting to make sense? So the farther expiration you go out, the slower the time decay. Okay, this really accelerates that last week. 2 weeks out ain't bad. 3 weeks, you're even better. Now, you can look at it as like, okay, well, yeah, but my percentage return is going to be lower on that. So let's say it does hit your 292.50, or, well, there we go. There. Okay, so we're going to say it hits 292.50 on 10/13. Okay, or well, it'd be 10/12. But so let's see. You're right here. You paid 194. Again, assuming it takes all week to get there. Yeah, you've got 100% return there. But it's a little riskier too, though. So going to this one, you're at you're 473. So what's your percent return on that? You're 473 minus 271 divided by 271. So you're 74% return. But remember, you're risking what was it, $76 of theta time decay here versus $194 at risk here. So your risk changes a little bit too. So that one was 74%. Let's go 3 weeks out. So we're at, they say it'll be worth 537 then. So 537 minus 326 divided by 326. So you're at 64% return. But remember, your time decay risk was basically, if it just stayed flat, was only $54 on this. So those two things kind of go hand in hand. And in terms of other things, picking strikes, I kind of look at it that way. But look at your support resistance levels. I had this goes back a ways, farther back even yet, but a couple different support lines on this too, and you can kind of see we kind of bounced that one, held the 50 days. So and it's entered a squeeze here. So there's a chance this may pop back up too. So and then the other thing that you can really look at, this is how I kind of started getting into all these diagonal trades I've been doing. So let's say you go 75 days ain't bad. Let's go 103 days out. That really stays out of our time decay here, and we can kind of compare a little bit here. We'll kind of have to go next strike up. So it's 795. Your theta's $4 a day, and this rounds us up or down. I don't necessarily care for that, because especially once you get into minus 0.01s, it's not a very accurate thing. So so if you look, the farther out you go, your daily time decay that you're losing decreases. Your cost in it actually increases too, so therefore your percent return decreases, but you're decreasing your risk. So you can look at it as short-term, real short-term trades like the weeklies are a real high risk and a higher percentage return. There's never any trade-off on these. And then you can look at it, the farther out you go, it's slightly lower percent return on capital, but it's lower risk because of time decay. I would not recommend buying same week of that, just because I mean, just look at how much you're losing there in time decay. 194, and then I think it was only $75. So I mean, it's, you know, a third of it roughly. So that's just my opinion on that. There's a lot of different ways of doing it. If you're in and out of stuff, if you're just day trading, yeah, fine. These aren't going to matter too much. But if you're one of those like, didn't get where I wanted it to today, I'm going to hold it till tomorrow, and then tomorrow turns into 2 days and 3 days, yeah, you're going to get killed on these. So you got to be pretty decisive and quick on trading those anyway. So where I went with doing these longer term expirations, I was buying these. So let's see, we'll say, yeah, we can probably just do December. So like I would buy the, and if you start looking at the percentage returns, it's not much different. If you're buying long-term expiration, like way out here, let's just do the math real quick. Let's say if you buy a 290, we're still basing this on October 13th, getting to our 292 mark. So let's buy a 290. They say it'll be worth 940 at 731 right now. So 940 minus 731. Okay, so that gives us 28% return on that one. But let's go, there you go. Oh man, I don't want to spend $731 on that. Say, let's just go way out here, 297, see what happens. Okay, so they'll say that's going to be worth $5 if it hits our target. We're paying $354 for that, so that sounds better, right? All right, so we're doing 500 and minus 354 divided by 354. So that gives you a 41% return. So it's kind of interesting that your percentages change a little bit, but you're almost better off buying out of the money if you go longer expiration, like 100 plus days or something is what I like to do. So again, let's see, I'll do, let's do this. So we'll say, here's what I would do. I would buy, when I was doing just these long expiration trades, I would buy, 295. Okay, so 457. Then I started looking at, okay, well, how can I decrease my cost in this? So based on that implied move, was 468 or something was our guess as how much it might move to get to 292. And so I would go here and sell this 292 there, and it decreases my costs. Yeah, I mean, that's not a good setup where it's at now, but yeah. So let's see. Whoops, I got some other stuff in here anyways, but anyway, you get the idea. So that's just kind of how I pick the strikes anyway. Hopefully that makes sense, and if you have any questions, let me know.